Welcome back to the deep dive. It is February 16th, 2026. Today, we're doing something a little different.
A bit of a gear shift.
Exactly. Instead of our usual narrative approach, we're going to simulate a formal investment committee meeting. We are essentially building a research memo in real time right here.
We are definitely putting the deep dive today. I mean, we're not just glancing at a stock chart or a headline. We're going to be tearing apart a very specific infrastructure asset to see what really makes it tick.
And our subject is the TVS Infrastructure Trust, or TVS InvIT. The mission is very, very specific. We're acting as institutional analysts. Imagine we're managing a hypothetical multi-asset portfolio.
Right.
We've got the Q3 FY26 financials, which just dropped a couple of weeks ago. We have the latest IVAS valuation reports, the credit rationale from ICRA, and a really fantastic deep analysis from the Druva Substack.
So we have all the puzzle pieces.
We do. And the question we need to answer by the end of this is simple. Do we buy, hold, or sell?
And look, just to be clear for everyone listening, this is going to be an intermediate to advanced discussion. We're going to be throwing around terms like cap rate compression, whale, spread analysis, input tax credits.
Yep.
So if you're managing a REIT portfolio or you're just looking for real, sustainable yield in the Indian market, this one is absolutely for you.
Okay, so let's start with the hook. The thing that, honestly, it stopped me in my tracks when I was going through the pre-read.
I think I know what you're going to say.
Usually when we talk about logistics or warehousing in India, it's always the same story. The Amazon effect, right? E-commerce, last mile delivery. But TVS and VIT, they seem to be playing a completely different game. They have this debt instrument that just looks like a financial anomaly.
You're talking about the 20-year bond arbitrage.
Right. I mean, how have they managed to lock in a fixed cost of debt for 2 decades in India? An economy where inflation and interest rates are, historically so volatile, it honestly feels like they found a glitch in the matrix.
It's not a glitch, but you're right to be surprised. It is a massive, massive structural advantage. It's really the centerpiece of the whole investment thesis.
Okay.
It effectively turns what looks like an equity instrument into a leveraged bond with a built-in inflation kicker. Yeah. But we'll get to the nuts and bolts of that in a bit.
Okay, let's start at the top, the executive summary. If we're in that boardroom right now, the CIO looks at us and asks for the bottom line. What is the recommendation?
Based on all the data, as of today, February 16, 2026, the recommendation is long. Accumulate.
Okay, long. Accumulate. Let's pressure test that right away. Because when I look at the headline numbers, I see the units trading at what? INR 112.50?
That's right.
That gives us an implied market cap of, call it, INR 2,218 crores. And the annualized yield based on that Q3 distribution of 151 per unit is sitting at roughly 5.4%. So here's my problem. A 5.4% yield in the Indian market. I mean, I can get close to 7% on a high-grade corporate bond. I can definitely get more in some of the other REITs, maybe NDR, or even some of the office plays if I'm willing to stomach the vacancy risk. So why should I lock up my capital at 5.4%? That feels really tight.
And if you're looking at it purely as a current income product, you're absolutely right. It does look tight. But you'd be missing the total return picture. This isn't a yield trap, where you buy a high dividend and then you watch your capital just erode away. This is a safety plus growth play. The entire thesis rests on 3 pillars.
Okay, let's walk through them. Pillar 1.
Pillar 1 is the financial engineering, the fortress, as I call it. It's that 20-year fixed-rate non-convertible debenture, the NCD. It's 7.42%, anchored by NABI FAD. That right there creates a floor on their costs that their competitors simply do not have.
Okay, we're definitely going to drill down on NABI FAD later, but the takeaway is they have a cost advantage that is locked in until, what, the mid-2040s?
Correct. Pillar 2 is asset class nuance. We really need to stop calling this logistics. It's not. This is industrial manufacturing. There is a world of difference between a shed storing cardboard boxes for Flipkart and a facility that's housing a Mercedes-Benz assembly line.
That's the stickiness factor you mentioned.
Precisely. And pillar 3 is growth visibility. The sponsor, TVS ILP, has a 20 million square foot pipeline, a huge pipeline. And importantly, the trust has just signaled its intent to acquire that pipeline by raising its leverage cap up to 49%.
So what here, the elevator pitches? You accept a lower starting yield, the 5.4%, because the cash flows are backed by these super sticky manufacturing clients.
Yep.
They're protected by a 20-year fixed debt structure, and on top of that, you get the upside of a massive acquisition pipeline.
That's the summary. You're buying a structural proxy for the China plus one manufacturing renaissance that's happening in India, and it's all backed by a AAA-rated balance sheet.
Okay, let's strip this engine down. I want to talk about the business model. You made this distinction, logistics versus industrial. To the uninitiated, a big metal shed is just a big metal shed. Why does that distinction matter so much for the valuation?
It all comes down to one thing: switching costs. Let's imagine for a second you own a standard logistics warehouse. Your tenant is a 3PL, a third-party logistics operator. What are they doing? They're storing pallets of soap or electronics.
Right, standard racking, a few forklifts, some loading docks, pretty simple stuff.
Exactly. Now, if a developer down the road builds a brand new park and offers them rent that's just 2 rupees per square foot cheaper, what does that 3PL do?
They pack up and move. It's a commodity service. The building itself is just a box. There's no real customization.
You just need a roof and a floor. But TVS is heavily weighted towards industrial. If you look at their tenant mix, it's auto components, engineering firms, heavy machinery manufacturers. When these guys take a building, they aren't just putting in pallet racking. They're pouring specialized concrete foundations to handle heavy vibrations from their machinery. They're installing huge overhead cranes that run the entire length of the building. They are putting in high-voltage power substations.
I've heard this described as the floor reinforcement moat. It's a great phrase.
That's a perfect way to put it. Once a tenant spends, I don't know, $5 million reinforcing the floor and bolting down a production line, they are effectively married to that building. They can't just move because the rent went up 5%.
The numbers don't work. The cost of the downtime, the cost of moving all that specialized machinery, it just far outweighs any potential rental savings.
It creates immense pricing power for the landlord, immense stickiness. And that's why you see their weighted average lease expiry, the whale, at about 5.5 years, but the occupancy is consistently pinned at 99 to 100%.
That's a key point. In a standard office REIT, you're constantly worried about vacancy. But in an industrial REIT like this, vacancy is almost a theoretical risk, not a practical one, as long as the manufacturing cycle holds up. And there's another layer to this business model we should touch on, the relationship with the sponsor. TVS Supply Chain Solutions, or TVS SCS.
The sister company.
Now, usually I get a little nervous about related party transactions. I mean, is TVS SCS just dumping bad leases into the trust, or is this genuinely strategic?
In this particular case, it really acts as a de-risking mechanism. TVS SCS is a global supply chain major. They have a massive operation. So they often act as the anchor tenant.
So before the developer, TVS ILP even breaks ground on a new park.
TVS SCS might come in and commit to taking, say, 30% of the space right off the bat.
Which completely eliminates the development risk.
It eliminates the initial risk, and it validates the location. If a giant like TVS SCS is going there, other tenants know the connectivity is good, the roads are good. It just creates this gravitational pull for other high-quality tenants.
Okay, so the business model is robust. But real estate is always about the dirt. It's geography. Let's talk about the moat, and specifically the location analysis. The portfolio is what, 10.66 million square feet spread across 18 parks, but let's be honest, not all 18 of those parks are going to be winners.
No, of course not. Any portfolio has a Pareto distribution. You've got your workhorses, and you've got your stars.
And the valuation report from IVAS is very clear about the crown jewel. It's the Chakan cluster in Pune.
Chakan is the alpha generator, 100%. If you understand what's happening in Chakan, you understand probably 40% of this entire thesis.
Okay, I want to push on this because I hear supply shock in Chakan. I hear rents are up. But India is a massive country. Why can't a competitor just buy the farm next door, pave it over, and undercut TVS? Why is there a genuine supply constraint?
It's a great question. And if you've ever driven through Chakan, you know the answer instinctively. This isn't the flat, easy plains of Haryana or the NCR. Chakan is geographically hostile. It's undulating terrain, it's rocky, it's hilly, it's uneven.
So the civil engineering costs are the real barrier to entry?
It's what's called the cut and fill ratio. To build a proper grade A industrial park, you need 50, maybe 100 acres of perfectly flat, reinforced concrete floor. In Chakan, just leveling that land requires massive earthworks. You're literally blasting rock. You're moving mountains of soil.
And that just destroys the developer's margin before they even pour a single column.
It completely destroys it. The easy land, the flat parcels, that was all gone 10 years ago.
So what's left are these fragmented, difficult parcels.
Exactly. And then you have the second layer, the regulatory layer, the MIDC, the Maharashtra Industrial Development Corporation, trying to aggregate 100 contiguous acres in Maharashtra right now. I
Yeah.
mean, you have to navigate a labyrinth of agricultural land conversions and village panchayat approvals. It's a nightmare.
So the barrier to entry isn't just capital, it's geology and bureaucracy.
That's why we're seeing the numbers we're seeing. Just look at the data from late 2025. Vacancy in the Chican micro market is hovering around 3.1%.
Which is effectively zero once you account for churn and friction.
It's zero. But look at the rents. This is the amazing part.
The report says market rents have hit 31 rupees per square foot per month.
That represents a year-on-year growth of nearly 34%. 34% rental growth in a single year. That's not normal. That is a clear signal of a supply squeeze.
And TVS is just sitting there with all these existing fully developed assets.
Correct. So when their old leases that were signed 3 or 4 years ago at maybe 22 or 23 rupees, when they come up for renewal, they're not negotiating for a little 5% bump. They are marking that asset to market. They're looking at a 30 or 40% jump in net operating income from that one specific box.
Let's move south. Chennai, the Origadam and Sriperumbudur belt. This has traditionally been known as the Detroit of Asia.
It has been. But the narrative there has really shifted in the last few years. It used to be all about Hyundai, Ford, Renault, Nissan. Now the big driver is electronics.
The China Plus One beneficiaries we hear so much about.
It's the Apple ecosystem. It's Foxconn, it's Pegatron, Cellcomp. We saw leasing activity jump by 50% in the second half of 2025 in Chennai alone. Rents are up, 4 to 8%. It's not the explosive growth you see in Check-in, but it's steady.
And crucially, it provides diversification. So if the auto cycle slows down, the electronics manufacturing boom can pick up some of that slack.
That's the portfolio strategy right there.
And then you have the Tier 2 strategy, Cuttack, Siliguri, Vijayawada. This feels a bit riskier too. These aren't established institutional-grade markets.
It's a calculated bet. It's a bet on the Gati Shakti infrastructure corridors. Take Siliguri, for example. It is the gateway to the entire northeast of India. Rents are stable, sure, around 21 PSF, but the competition, it's zero.
You're competing against, what, unorganized go-downs?
Exactly. You're competing against mud floors, 10 roofs, and no fire safety. TVS comes in and builds a grade A box with proper sprinklers, dock levelers, and turning radiuses for 40-foot trucks. For a company like Amazon or a national FMCG player, there is no choice. They have to lease the TVS asset because nothing else even comes close to meeting their compliance standards.
Speaking of compliance, let's touch on ESG. Usually, I'll be honest, I roll my eyes a bit when companies start talking about ESG. It so often feels like greenwashing. But you think there's actual commercial value here?
There is a hard commercial edge to it, for sure. TVS has this EDGE Advanced Certification, which is a standard from the IFC, part of the World Bank. The numbers are impressive. They save 14 million energy units annually. But the real commercial value comes from their tenants.
The green premium.
It's more than a premium, it's a prerequisite. If you are a supplier to Apple or Amazon or Mercedes, you have a net zero mandate that was signed at the global level in Cupertino or Stuttgart. You cannot lease a building that isn't certified green. Your own internal compliance physically will not let you sign the contract.
So it restricts the supply even further for those high credit tenants. They are forced to choose the green building.
Exactly. It ensures that the highest credit quality tenants prioritize TVS buildings over a potentially cheaper but non-compliant local developer. It's a filter for tenant quality.
All right, let's get to the main event. Pillar 1, the financial engineering. You call this the financial fortress. And I really want to be skeptical here. You said they have a 20-year fixed-rate bond at 7.42%.
Yes. INR 830 crores of non-convertible debentures, NCDs.
Okay, hold on. We are talking about the Indian debt market. This isn't the U.S. Treasury market or the result of a Japanese zero-interest rate policy. In India, a 20-year horizon that usually comes with a massive liquidity premium, a massive inflation risk premium. Who in their right mind lends money at 7.42% fixed for 20 years when consumer inflation creates so much volatility? Who is taking the other side of that trade?
That is the billion-dollar question. And the answer is NABI FID, the National Bank for Financing Infrastructure and Development.
The government-backed infrastructure lender.
Correct. This is not a standard commercial bank deal. You are not going to HDFC Bank or SBI and getting this kind of term sheet. This is a policy-driven instrument. NABI FID's entire mandate, their reason for existence, is to deepen the long-term infrastructure bond market in India. They need to deploy capital into long gestation assets like these.
So TVS essentially capitalized on a policy window. They are the beneficiaries of a specific government push to stabilize infrastructure funding.
That's exactly what happened. They captured a moment in the credit cycle that might not be repeatable for their peers. I mean, if you go to the bond market today as a AA-rated entity, you're not getting this tenure, and you are certainly not getting this rate fixed.
No, you're probably looking at flowing rates linked to the T-bill or MIBOR plus a spread.
And that leaves you completely exposed. If inflation spikes in 2028, your interest cost spikes.
But TVS has effectively immunized their balance sheet against the single defining risk of real estate, the rising cost of capital.
Completely immunized.
Yeah.
For 2 decades.
So let's look at the math of the arbitrage, because this is really where the wealth creation part of the story happens.
Right. So on day one, they're borrowing money at 7.42%. They are then using that money to buy assets at a cap rate, which is the entry yield of roughly 7.75% to 8.0%.
Okay, so there's a small positive spread immediately, about 30 to 50 basis points, not huge.
A small positive spread, yes. But that is not the magic. The magic is time. The cost of their debt is fixed. It stays at 7.42% in year 1, year 5, year 10, year 19. But what happens to the rent?
The rent goes up. The leases have built-in escalations.
They do. Typically 5% annually or 15% every 3 years. So just imagine we're in year 10. The debt is still costing them 7.42%. But the yield on the original cost of that asset, because of all that rental growth, it might now be 11 or even 12%.
So the spread widens over time.
It explodes. It creates massive equity value accretion. This is what we call the jaw of the crocodile. The revenue line goes up at a 45-degree angle, and the interest expense line stays perfectly flat. The space in between is pure profit for the unit holder.
And it completely eliminates refinancing risk.
Yeah, crucially. Look at their peers' embassy, NDR. Every 3 to 5 years, they have to go back to the bond market, cap in hand. If interest rates spike to 9% in 2029, their cash flows get hammered. Their distributable cash flow drops. TDS is completely immune to that interest rate risk for 2 decades.
It's an arbitrage on the duration of the liability versus the growth of the asset. It's brilliant, provided, of course, that the asset quality holds up.
Provided the tenant keeps paying the rent. That is the only real variable.
Okay, let's ground this in the latest numbers. We have the Q3 FY26 financials for the quarter ended December 31st, 2025. What's the health check look like?
It's steady as she goes. Consolidated revenue for the quarter was INR 62.54 crore. And if we estimate the margins, industrial leasing usually runs very high margins. We're looking at a net operating income, or NOI, of somewhere between 53 to 56 crore.
Which is an 85 to 90% margin. Very healthy.
Very healthy.
And what about the distribution? The cash that actually gets to the unit holder?
They paid out INR 29.78 crore in total. That translates to a distribution per unit, or DPU, of INR 1.51.
Now, for the tax nerds listening, and frankly for any investor who cares about their post-tax returns, there is a detail in that DPU breakdown that matters a great deal.
A huge detail. That DPU isn't just one bucket of money, it's split. INR 1.13 is classified as interest income, but INR 0.38 is classified as repayment of capital.
Repayment of capital. That is the magic phrase for high net worth individuals in India. Explain why that's so important.
For the investor, the repayment of capital component is generally tax-free in the hands of the unit holder. It lowers your cost basis on the unit. Sure, so you might pay more capital gains tax when you eventually sell years down the line, but you don't pay tax on that cash flow today.
So if I'm in the 30 or 40% tax bracket, a significant portion of my yield is effectively tax exempt.
Exactly. So while the headline yield is 5.4%, the tax-adjusted yield compares very, very favorably to a standard fixed deposit or a fully taxable bond yield, where the government's taking a third of your coupon payment every year.
All right, let's talk valuation. This is where I struggle a bit. The unit price is INR 112.50. The net asset value, the NAV, is hovering somewhere between INR 106 and INR 111, depending on which model you look at. So it's trading at a premium, about 1.16 times NAV.
It is trading at a premium, yes.
Let's just pause on that 1.16x NAV multiple. As a value investor, that makes me twitchy. We're seeing office REITs right now trading at deep discounts to NAV, sometimes 20, 30% below. And you're telling me I should pay 116 rupees for what is technically 100 rupees of assets. That feels like we're pricing in a lot of perfection.
And it would feel rich if you were looking at it through a pure traditional real estate lens. If this were just a random collection of warehouses, I would agree with you 100%. But you have to look at the volatility of that NAV.
You mean the stability of the cap rate they use for valuation?
I mean, the certainty of the cash flow that underlies the valuation. When you buy a discounted office REIT, you are taking on the risks that IBM or Accenture doesn't renew their lease. You are actively buying vacancy risk. Here, that premium you're paying, it's the price of insurance. The market is saying we will overpay slightly for the certainty that this 5.4% yield isn't going to evaporate overnight.
Okay, so I'm paying a premium for a sleep well at night tax. I can see that logic. But does the math actually hold up? The IVAS valuation report, they used a WACC of 11.58% and a terminal cap rate of 7.75%. Do those numbers seem fair to you?
They seem reasonable, perhaps even slightly conservative. A 7.75% terminal cap rate for high-quality industrial assets in a growing economy like India. That provides a pretty good margin of safety. I mean, if interest rates drop in the broader economy over the next decade, that cap rate will compress and the NAV will jump. So you've got potential macro tailwinds working for you too.
Let's look forward. Pillar 3, growth. The capital structure seems to be gearing up for something big.
Right now, they're very under-leveraged. Their net borrowings ratio is only about 0.30 or 30%. The debt to equity is 0.52x. They have plenty of headroom on their balance sheet.
And they're actively asking for more room.
The postal ballot notice from October 2025 was the big signal. They went to unit holders and sought approval to increase their borrowing limit all the way up to 49%.
You don't ask your bank for a credit limit increase unless you're planning to go on a spending spree. This isn't just routine housekeeping.
Exactly. They are loading the acquisition gun. The sponsor, TVS ILP, has that 20 million square foot pipeline just sitting there. And the ROFO, the right of first offer agreement, means the InvIT gets the first look at all of those assets as they're completed.
So let's just trace the mechanics of a future deal here. They raise more debt, maybe not at that magical 7.42% this time, but let's say they get 8%.
A reasonable assumption.
And they use that to buy an asset from the sponsor yielding what?
They'd probably buy an asset yielding 8 to 8.5% initially.
So the initial spread is thin again?
Initially, yes. But remember the development premium. By buying a completed, leased-up asset from the sponsor, they eliminate all the development and leasing risk. And as they scale, they reduce their overall expense ratio. There's real operating leverage in this model.
But the real growth comes from the sheer volume. They're clearly signaling they want to double the AUM.
It is the classic REIT growth model. Acquire, stabilize, refinance, and repeat.
Yeah.
But it's turbocharged by that incredibly low-cost debt structure they already have locked in place.
We have to look at the competition, though. Relative value. Why should I buy TVS at a 5.4% yield when NDR InvIT is sitting right there offering, 7.4%? That's a huge gap, 200 basis points.
It is a big gap. But you have to ask yourself, what is that gap pricing in?
Risk.
It's pricing in risk. NDR is rated AAA, plus TVS is rated AAA. In the bond world, that one-letter difference is a chasm. NDR has shorter-term debt with constant refinancing risk. TVS has the 20-year lock. NDR is arguably more of a pure current income play. If you need cash now to pay your bills, maybe you look at NDR. But TVS is a safety plus growth story.
It's almost a difference between buying a high-yield corporate bond and buying a sovereign bond.
That's a very fair analogy. And if you compare it to Embassy REIT, well, Embassy is office. The office sector is dealing with global headwinds, vacancy risks in SEZs, the whole work-from-home overhang. Industrial has secular tailwinds, the PLI schemes, manufacturing, made in India. It's just a much cleaner growth story.
And what about the global benchmark? Prologis is the gold standard for industrial real estate.
Prologis yields about 3.1% in the U.S., but they have massive, massive growth potential priced in. TVS is trying to bridge that gap. They offer a much better starting yield than Prologis 5.4%, but with an expected total return of 12–14% when you factor in the growth. It's a real sweet spot for an emerging market asset.
All right, we've been pretty positive so far. But my job here is to be the skeptic. What breaks this thesis? Let's do the risks, and I want to get specific.
Absolutely. There are real risks.
Yeah.
And the first one is actually the flip side of that amazing 20-year bond. We call it the tenor mismatch.
Explain that.
The debt is locked for 20 years. Fantastic.
Yeah.
But the leases, the whale is only 5.5 years.
So the tenants can leave in 5 or 6 years, but the debt payment is still due for the full 20.
That's it exactly. You have significant releasing risk. What if in 2030 the entire auto sector crashes? What if there's a massive unexpected oversupply of warehouses in Pune? Market rents could crash. TVS would still have to pay that fixed interest coupon. but their rental income could drop substantially.
Which would squeeze the distribution.
It would squeeze it severely. Now, the mitigant, as we discussed, is the sticky nature of the manufacturing tenants. They're far less likely to leave. But the risk is absolutely non-zero.
What about concentration risk?
It's heavy on the auto sector. Chakan, Oregadam, Hosger, these are all major auto belts. If the global auto cycle turns downward, or if EV adoption disrupts the traditional ICE supply chain faster than anyone expects, you can see pain across multiple assets all at the same time.
And digging through the financials, there are some specific skeletons in the closet, aren't there? I was reading the notes to accounts, specifically note 34, regarding contingent liabilities.
You always have to read the fine print. And there's a very specific line item in there. INR 25.6 crores related to an indirect tax dispute.
This is the input tax credit, or ITC issue, isn't it? This has been plaguing the entire construction and real estate sector for years.
It is. The tax authorities are arguing that the ITC claimed on the construction of the warehouses, specifically on the civil works, isn't valid under the GST regime. The company is contesting it, and they have a strong case based on the Safari Retreat's High Court judgment, which generally favored the taxpayer.
But that matter is still pending at the Supreme Court level, right? So this isn't just a TVS issue. This is a systemic industry-wide risk. If the Supreme Court rules against the industry, that 25 crore liability becomes a real cash outflow immediately.
Precisely. And while 25 crores isn't going to bankrupt a trust of this size, it would definitely put a dent in the distributable cash flow for a quarter or two. It is a binary regulatory risk that I don't think is fully priced into the stock right now.
So a key due diligence checklist item for anyone listening, monitor that tax case very closely.
Absolutely. And monitor the lease renewals coming up in Chakan. We've talked about the market rent being INR 31. Are they actually signing renewals at 31? Or are they having to give discounts to keep tenants in place? That will be the proof in the pudding.
Okay. If we had the CEO of the investment manager in the room with us right now, what are the 5 hard questions we would ask them?
Okay, number 1. With the borrowing cap now raised to 49%, which specific assets from the ROFO pipeline are you targeting for acquisition in FY27? We want names and numbers.
Right. Don't just tell us growth. Show us the map. What's number 2?
Number 2, how much the Chakan portfolio, by square footage, is coming up for renewal in the next 12 months. We want to know exactly how much of that 34% market rent growth is going to hit the P&L and when.
Show me the money. Number 3.
What is the board's strategy for the indirect tax dispute? Are you making provisions for a potential loss, or are you operating under the assumption of a definite win? What's your plan B?
Good one. Number 4.
Are you seeing any slowdown in demand from auto ancillary tenants in Oregadam? We know the electronics story is hot, but are you seeing any cooling off in the traditional auto sector?
And the last one for the yield hunters.
Can we expect the repayment of capital portion of the distribution to increase, decrease, or stay the same in future quarters? That tax efficiency is a major selling point. We need to know if it's a sustainable feature of the payout.
That's a great list. So let's bring it all home. What's the final conclusion for our institutional listener who's been following along?
TVS InvIT is a sleep well at night asset. It offers real inflation protection through its rental escalations, and it offers almost perfect interest rate protection through that unique 20-year bond. We are projecting a total shareholder return, a TSR of roughly 12 to 14% CAGR. That's your yield plus your growth.
So it's a defensive play, but with very clear offensive characteristics.
That's the most concise way to put it, yes.
Okay, before we sign off, here's a provocative thought I want to leave everyone with. We've spent a lot of time today praising this 20-year bond structure. What happens if this becomes the new standard? If other infrastructure trusts start getting access to this kind of long-term fixed debt via NABFI, what happens to the valuations of the older REITs?
The ones that are stuck on 3-year floating rate debt.
Exactly. Do they suddenly get derated by the market? Does the market start demanding a duration discount on them because they carry so much more interest rate risk? It's something to think about as the Indian financial markets continue to mature.
And for anyone who wants to do their own homework, pull up that IVIS valuation report. Don't just look at the final NAV number. Scroll down and look at the land price assumptions they're using for Chakan. Then go to Google Earth. Look at the density. Look at the geography. Verify that scarcity for yourself.
Stay curious and stay invested. We'll see you on the next deep dive.
Take care.